Hello everyone. I hope all of you guys are doing good. So welcome to the Financial Management pre-mock June 2026. So in this session, we are going to unveil the entire mock of 2026 June for financial management, right from section A till section C. Each one of the question we're going to analyze and understand and what is the reason behind the question being asked and how the answers are solved, what things can go wrong in the main examination. We assume that it is actually our main examination instead of thinking it is going to be a mock. So right from the very first question till the last question, I'm going to solve, and you guys can make a note of it. If there is any kind of doubts, of course, you guys can always comment, or you have my mail ID and you can send the mail. So without delaying, let's get into the section A part of your mock pre-mock June 2026, everyone. Right. So I hope all of you guys know how to assign this mock. If you don't know, you can always see there is an option that where I have I conducted a video which I'll be tagging in the comment section where you can go through that video first to understand how to assign the pre-mock for yourself, and then you can use that to continue the examination. Right. So without delaying, let's get into the section A part. In section A, we have 15 objective type question, that is OT question, and each question carries 2 marks, and all of the questions are compulsory, which is worth of 30 marks. Okay. So let's start with the very first question, guys. So if you can all see, the first question that we have here is from the working capital management topic. So what is it saying? So always we need to read the requirement and before going ahead and reading the information. So I always read the requirement. So what is the requirement here? What is the net annual benefit or cost offering the discount which is nearest to the 1,000? So good thing is we have MCQs. When you have a choice on the answer, it is always good. Yeah, because even the closest answer can lead you to get the right one. But when it's a fill in the blanks, we might have to be little careful on that. Continue. Let's read the question. Coin company has annual or Coin company, whatever you want to call it as, has an annual credit sales of 4.5 million, and right now they are offering a 30 days credit, but the customers are actually taking up around 50 days on an average to pay back to the company. Now we are thinking to offer an early settlement discount of at least 1% for the payment within 15 days, so that I will be able to what? I will be able to have a better cash flow. This is what they want to do. But not all the customers are going to take up the discount. It is estimated only 40% of customers will take the discount, and the remaining customer will continue to take 50 days. Now, Coin company finances its overdraft at 8% per year. The question is, what is the net benefit or cost for offering the discount to the nearest thousands? Because now we need to first, before I go ahead and talk anything, now what is the benefit? What is the benefit of reduction in receivable days? See, guys, you need to understand receivable days reduces, receivables value also reduces. That means we collect the cash faster. Continue. That means we collect the cash faster. So we collect the cash faster. Yeah, sooner the cash will save overdraft interest, bank OD interest for those many days. This is the benefit. But what is the cost of it? The cost will be the 1% discount that we are offering to the customers on the sales. I am foregoing the profit margin. 1% giving discount is like reducing the sales price by 1%. Now, first we have to understand what is the reduction in receivable days. For that, we need to know what is the new receivable days, because we know old receivable days are 50 days, but new receivable days is based on the probability analysis, because 40% of customers will pay within 15 days, but remaining 60% will still take what? 40% of customers will pay 15 days, but the remaining 60% will still take up 50 days of your old receivable days. So if you take both of them, take a calculator here, change it to standard, everyone. So it is gonna be 40%. Continue. I have to take 15, sorry, into 40 percentage, that will be 6 days plus 50 into 60 percentage, I'm sure it is going to be 30. So we can expect to have overall 36 days as the new receivable days. Now you guys tell me, what is the reduction in receivable days? Reduction in receivable days shall be 6 plus, I mean from 50 days, we are going to 36 days. That means the reduction is 14 days. So now what is the total reduction in receivables? Total reduction in receivables shall be 14 days divided by what? 14 days divided by 4.5 million multiplied with 365 days. Sorry, 4.5 million, I'm doing vice versa. So how do we calculate receivable collection period, guys? Receivable collection period is calculated by taking up trade receivables divided by credit sales into 365. But if I need to find out the trade receivables, how much is it getting reduced? What should I do? I should go ahead and take the 4.5 million multiplied with 14 divided by 365 days, and that shall give me a total reduction in receivables. How much is the total reduction in receivables that you can expect to have if you use the calculator? Once again, is you can either use this calculator or you can use your own calculator that you take into the examination. That is totally up to you guys. So I can expect to have somewhere around $172,602 is what the reduction that we can expect to have. So the reduction will be close to $172,603. Let's keep 172,603. So I will collect, I mean, reduction in receivable is I will collect the cash so much faster. So my savings shall be 8 percentage. If you can all see here, they have told what? They have told 8 percentage of per year as the savings that I'm paying. I mean, overdraft that I'm paying. Because I'm collecting the so many amount, like, faster in nature, I shall go ahead and save 8 percentage of $172,603, which will be 172,603 multiplied with 172,603 multiplied with 8 percentage. I'm saving around $13,808. But to save this, what is the cost? The cost is 1 percentage discount, where out of 4.5 million, not all the customers are actually taking up the discount. Only 40 percentage are taking up the discount. So can I say 4,500, that is 4.5 million multiplied with what? Multiplied with 40 percentage. 4.5 million multiplied with 40 percentage of customer will take up 1 percentage discount, and that's my cost of this. So if we have to consider, that is 4.5 million into 40 percentage into 1 percentage, it's gonna be 4.5 million multiplied with 40 percentage. On that, 1 percentage shall be $80,000. So this $18,000 is my what? $18,000 is my cost of it. So what is the net cost? Because I see the cost is higher. 18,000 is what the cost that I'm incurring to save 13,808. So approximately, can I say that I'm actually saving how much, guys? I'm sorry, I'm actually incurring more cost of how much? 18,000. 18,000 minus 13,808. That gives me a overall savings of $4,192. But the nearest thousand to this is thousands to this is $4,000 of cost. So the answer has to be for this question has to be how much? Has to be net cost of $4,000. This should be the right answer, guys. Option B. I hope all of you guys are clear on that part, right? See, sometimes what happens, one question will take a long time, another question might take very small time. It's totally fine. We don't have to be worried about it. Okay, so let's move to the next question. See, this question is very simple. Yeah, so this question is Very, very simple. So what is the question talking about, guys? So what is the question that is talking about? See, the question has a clear, indication here, which says yeah. So the question has a clear indication which says which of these is the best indicator of shareholders' wealth? So we all think like, ma'am, annual contribution or market share or maybe, ma'am, cost of capital. No, guys, see, the right answer for this question has to be what? The right answer for this question has to be simply market price of each share. Because if you consider, I always assume market is efficient, right? So the price of a share is nothing but the present value of all future dividends that we are expected to pay to the shareholders. So that is the shareholders' wealth. So this, it is the best indicator on the overall list, isn't it? Because ultimately the market share is nothing but the total, the how business holds the share in the market. No, that is not talking about the wealth of a shareholder. And cost of capital is the return, right? It is always about the present value of future cash flows that we can expect to have from that particular share. That is nothing but the market price of each share, and the answer has to be simply option C, right? Yeah. And look at the next one. So what is the next one talking about? The next question talking about, see, a government is attempting to stimulate, okay, the government is attempting what? Stimulate economic growth during a period of stagnation. First, what do you mean by stagnation? That is something that you guys need to understand. So what do you mean by stagnation? See, stagnation is sometimes for example, like per se, like there is a stage of where we are all inactive. I mean, like we are not able to grow. For example, an economy which has a very struggling period, like no growth, where wages are the same price, like there is no adding up values, so that we simply call it as what? Stagnation. So what do they do? Like, the government is trying to stimulate. I mean, they're trying to artificially grow the economy in the stagnation by adjusting its fiscal policy. So in this situation, which of the following combination of fiscal measures is most likely to increase the level of investment by private sector companies? That is what they're asking us to calculate. I mean, provide the answer. The first one says increase in the rate of corporation tax and decrease in government spending on infrastructure. Guys, fiscal measures means less cash is being spent on corporation tax, right? Because less tax is spent, it increases the value of investment. With projects with having a capital allowances, you can actually induce the private sector growth. So increase, I don't think so that is going to stimulate. And look at option C, a decrease in the rate of value added tax and a decrease in central bank interest rate. Okay, guys, change in the interest rate is completely related to monetary policy, not fiscal policy. So option C also cannot be the answer. And the fourth one is a decrease in personal income tax and an increase in the level of government borrowing. See, decrease in personal income tax or and VAT may boost the customer spending, but this will not directly address the requirement of increasing investment level by private sector companies. Yes, you reduce income tax, that doesn't mean all of them will go ahead and only invest in the private sector companies. But if you look at the second point, what is it saying? Decrease in the rate of corporation tax and increase in capital allowances for new equipment. So, see, if you increase the corporation tax, it would reduce the amount of retained earnings available for investment. Right? So, what do? You go ahead and reduce the investment. So, if you decrease in the corporation tax, that will increase the retained earnings, which will help you to increase in what? Increase in new investment. And new investments will always get attracted when you provide good capital allowances. That is the right answer for the third one, guys. I hope you are clear on that part. Right? Yeah. See, now we took very less time to cover the remaining three questions. Remaining two questions or whatever it is, because it is all theoretical question, but conceptual knowledge is very, very important. Right? look at the next one. Which two of the following statements regarding the function of financial markets are correct? So they're talking about what? They're talking about financial markets. The capital market is a market for short term securities. This capital market deals with both long term debt as well as equity. But only money markets are about what? A short term liquidity. If you remember, in debt finance, people say, like, go invest in money market, like, heard about money market, hedge, and everything, because it is a short term part. Right? Look at the second one. The money market provides short term liquidity to companies and banks, which is very much true. And also look at the third option. The secondary market facilitates the trading of existing securities. The secondary market are essential for the trading of existing instruments. The primary market comes from the company. So option B and C has to be the right one, but let's also see option D once. Commercial papers have a short maturity and would be traded on a money market, not a capital market. That is the normal thing. But here, what are they trying to say? Commercial papers are traded on the capital market. See, it is short market. It will be traded on what? Money market, not in the capital market. The answer has to be option B and C, guys. Right? Great. Let's move to the next question. What does the next question says? Again, see, ma'am, let's say we are solving a question and we've been getting only theoretical question which we are not liking. Let's say it's becoming too much for our head at once. So what do you guys have to do? You should go something called navigator here. You can always jump to the different questions. Let's say I don't want to do 5. I might feel like it has so much of theoretical thing, like it might not be the right thing that I have to do. You can always click this as flag for review. Go for navigator. Go for question number 6. Ma'am, this is also theory I don't want to do. Flag for review. Go for question number 7. Now, ma'am, this is a practical question. Can we go ahead and solve this first and come back to question 5 and 6? Yes, you can always do it. Yeah, but I'm not going to do, since it is pre-mock analyzation that I'm doing. So let's go to the question number 6. And question number 6 talks about what? Disrelief is what? Disrelief is a non-governmental organization, that is NGO, that provides emergency food parcels to families in disaster zones. The organization is undergoing a value for money audit for its primary operations. So what is value for audit? It is based on 3 V's. Correct? Yeah. So, which of the following performance measures would be most or appropriate to assess the effectiveness of disrelief? Okay. The total cost incurred to transport 1 ton of food to a disaster zone. Guys, it's all about economy, effectiveness, and efficiency. Right? 3 E's. Now, the total cost incurred to transport 1 ton of food to a disaster zone. I mean, you're talking about that cost which you have incurred, but if I have to talk about the effectiveness, see, when you talk about cost, we are talking about more of an economical thing, right? Yeah. But when I talk about effectiveness, I'm talking, has it reached the goal what I'm supposed to do? That is what the effectiveness means, right? Efficiency talks about, are you able to get things in a very less cost? That is efficiency. Economic, sorry. What is efficiency? Are you able to get the maximum potential out of the sources that you have sourced? That is efficiency. But what you wanted to reach, what you wanted to achieve, that goal is achieved or not, that is effectiveness. So we look at that. The first one is talking about economy. Look at option C. Average time taken to package 1 food parcel at the central warehouse is more of an efficiency. And look at option D, the successful negotiation of a 10% discount on bulk grain purchase. Once again, it is what? It is a proper cost element. So that is also economy. If you look at the option B, the percentage of families in the disaster zone who report that their nutritional needs were met by the parcels. I mean, ultimately what I wanted to do, has it reached, has it achieved? That should be the answer, and that has to be option B, everyone. And look at the question number 6. Which of the following exchange rate theories suggest the difference between spot and forward exchange rate is determined by the Interest rate, guys, it is very simple. Don't use the word ma'am expectations theory, international fishes. No, guys, spot and forward is based on interest rate parity theory. Spot and expected future rate is based on purchase power parity theory. Interest rate parity theory will use interest rate, purchase power parity theory will use inflation. So the answer has to be simply option B. Such a simple question, right? Let's move to the next one. A company make 1 for 5 rights issue. A company make 1 for 5 rights issue at a price of $4 per share. The theoretical X rights price is also given, that is 5.25. What was the share price before the rights issue? Guys, it is a reversal calculation that we might have to go ahead and do. So if you take the, let me take the scratch pad to you guys to understand. Is what is the total value of shares? See, they have given TERP, that is theoretical X rights price. That is nothing but after rights, after rights we have, after rights we have 6 shares, and multiplied with each share has a TERP price of 5.25. Correct? Each share price having a share price of 5.25. Take your calculator, take the total value, that is 6 multiplied with 5.25 is your TERP. So that means overall we have 31.5 is the value. In that I know the rights, which is one share issued at what? One share issued at $4. Correct? If you eliminate that, I will have before rights, it would have been 5 shares trading at overall together, I mean overall value of 31.5. May, if you eliminate that $4, so the remaining value, it would be trading at what? It would be trading at 27.5. That is for all 5 shares. So for each share, it would have been 27.5 divided by that 5 shares. And you do that, you shall get an answer of how much? 5.5. So the answer for this question has to be how much, guys? The answer for this question has to be simply 5.5. Fair enough? Let's move to the next question. What is the next question says? Which of the following is not a typical benefit of centralizing the treasury function? See guys, treasury function is like a cash function of the organization. I want one department who can take care of everything instead of me having multiple departments. So that in that case, if I have to talk about economies of scale and borrowing, what is economies of scale and borrowing? I'm talking about like ultimately I want to make a lesser interest cost. See guys, if you have one department, they have a better negotiation skills. Better negotiation skills, they'll end up what? They'll end up getting lesser interest where economies of scales are achieved. Fair enough? And improved ability to match foreign currency income and expenditure. Why? Because let's assume I have one country which is, I have multiple countries. If I have one centralized system somewhere, I'll be able to match the ability. I'll be able to find it out with the problems. Correct? And improved sharing of knowledge and expertise, of course guys, because there will be a lot of people who are expert in that particular field. That's when that they're coming and sitting here. The question here is, which of the following is not a typical benefit of centralizing the treasury function? Because if you centralized, you can't give the whole power to local managers. So that should not be the benefit of what? Benefit of centralized treasury function. The answer has to be option C simply. Right. Let's move to the next question. Again, a practical question, guys. The following information relates to Berco company, that is share price of $3.5 is given, earnings per share is given, sector average price earnings ratio is 12. Based on the PE valuation method, you have to check whether it is overvalued or undervalued related to its sector, guys. You guys need to understand, if PE ratio is more, the shares are overvalued. If PE ratios are less, the shares are undervalued. So how do you calculate PE ratio, guys? PE ratio is calculated using PE ratio is calculated using, guys, you know what? Sometimes the formula is right in front of you, we don't remember. So it is nothing but price divided by P stands for price, E stands for earnings, and you have to find out the number of times. Here the share price is 3.5 and I am paying a earnings of $2.25. So that should give me a PE ratio of how much? A PE ratio of 3.5 divided by 0.25. So should give me 14 times. Industry average is 12 times and you are collecting more values. So 14 times is going to be overvalued the shares. So the answer for this question has to be option D. Don't take undervalued. Don't do it. It's not inverse relationship. It is the direct relationship. I hope we are all clear on question number 9 too. So let's move to the question number 10, everyone. Such a simple question once again. Inflation is expected to be 4% per year. A project has a nominal cash flow of $50,000 in year 3. The real cost of capital is 6%. What is the present value of the year 3 cash flow to the nearest $10 nearest dollar? So what are they talking about, guys? They're simply asking one present value. So now do you include the inflation part? Because lot of us, what do? We will say, okay ma'am, inflation is expected to be 4%. Let me go ahead and consider the inflation part. See, you guys need to understand that all you have to find out is they have given 6% real cost of capital. This inflation has to be used to calculate what? To calculate the nominal cost of capital. So how do you go ahead and calculate the nominal cost of capital? It is nothing but 1 plus, see, Fisher's formula, guys, nominal cost of capital is calculated using 1 plus I into 1 plus H. H is nothing but inflation. Correct? Yeah. So what is 1 plus I? Guys, you can see, always go help formula sheet. If you go to formula sheet, you can see formula sheet, and I don't think so Fisher's formula would be, yes, see, Fisher's formula is given here. I don't know if it is visible. Yes, it is visible. Guys can see Fisher's formula is given. You can use this formula. Ma'am, I don't know the formula. Always use the formula sheet for your help, for your rescue. So this is what Fisher's formula. So what is it? 1 plus R is equals to 1 plus I into 1 plus H. So what is 1 plus I? 1 plus I is nothing but 1 plus 6% plus 1 plus H is nothing but 4%. So if you take the calculation, take your calculator, because you can use either your calculator or the calculator from the portal. Either ways it works. See, I would suggest you to use physical calculator because you're quick on that. I don't have an option to show the physical calculator. I can't present the screen. That's the reason I'm using it. So how do you go ahead and calculate, guys? You go ahead and calculate using 1 plus 6%, that is 1.06. So you can simply use 1.06 multiplied with 1.04, whatever we get, and this we minus 1. So that should give me, if I convert into percentage, it is going to be 10.24%. Ma'am, why we are minusing, guys? It's 1 plus R is equals to. So when you take the values, it is going to be 1 plus R. It's going to be 1 plus R is equals to 1.1024. This is the answer you would have got. Now R is equals to 1.1024 minus 1. So R shall be 0.1024, or it is also converted to what? Converted to 10.24%. So now how do we calculate? You guys should understand that first I need to calculate discounting factor for 3 years. Don't use annuity factor or table here because it is not possible. Sometimes, ma'am, I don't know how to calculate. What will I tell you, guys? I will tell you to go to navigator, go to some random question number 33 or question number 34, something like this. You'll get a spreadsheet. So what will I do? I'll use 1 divided by 1 plus 10.24% raised to the power 3. So I got what? I got the discounting factor, and the discounting factor here is how much? It is 0.746. What can I do? I can use this, multiply with, go back to the question that you were doing maybe. We were doing question number 9. Oh, sorry, question number 10. So what you can go ahead and use, this multiplied with $50,000 should typically give you the present value, guys. I know it is a lot of stunt. I'm not saying no to that, but instead of you taking your time and going to the calculator, multiplying with 1 divided by 1 plus, no, you can directly do this. So 0.746 is what we got. So the answer is somewhere close to 37,300. So the answer has to be how much? The answer has to be option C. So ma'am, I'm not getting exact answer. Is it fine? It's fine, guys. It's totally fine. So what I would suggest, if you want exact answer, let's say if you're doing, go to the same question number 33 or whatever it is, or 34 or whatever it is. What I would suggest you guys is do this, is equals to 50,000 multiplied with 1 divided by 1 plus 10.24 percentage raised to the power 3, close the bracket. You shall be getting 37,321, the exact answer. Don't waste your time on the calculator. That's what I would say. Right? So you can directly go with what? Directly go with the exact answer. The exact answer has to be 37,300. Right? I think there is a network error. Let's fix this, guys. Got it. Okay. So if you guys can see, what is the next thing? So yes, the answer has to be 37,300 or 37,321. You can do either ways. But yes, ultimately I want the answer. Right? Let's move to the next question. So it's about the proper Islamic finance, direct hit theory, guys. Yeah, you don't have to bother about it. The question here is, which of the following Islamic instrument best represents lease finance? Yeah, see, lease finance is properly what? Ijara. Because if you guys see, riba is interest. Yeah, so which is strictly forbidden in Islamic finance. First thing. So, and mudarabah is nothing but profit sharing. I mean, the fundamental principle of mudarabah is profit sharing. And you also have, investment is treated as what? It is treated as like certain business sectors like alcohol, gambling, or tobacco is not encouraged. So the answer has to be strictly what? Strictly ijara. That is the one which is talking about the lease finance. Yep. Okay. And look at the next one. How a company wishes to hedge an interest rate payment on a floating rate loan, it fears interest rate will rise. Which of the following derivative strategies would provide protection against a rise in interest rate? See, guys, I have a payment on a floating rate loan. My problem is there is a chance where the interest can go up and I might end up paying more interest. Correct? Yeah. So now currency is not an option because currency is about foreign rate exchange risk. It's not about the interest rate exchange risk. So option C is removed. Buying a put option on shares. Guys, why do you go ahead and buy a put options on shares? See, it is also against the share price, not the interest rate changes. The answer has to be either option A or option B. Now, if I buy an interest rate future, it would protect me against what? Against the falling interest rate. Here my problem is what? Here my problem is, what if the rise in the interest rate in the future? So I will go ahead and sell the future. If the rate rise, the price of the future falls, where I will go ahead and buy back the cheaper one and I make the profit to offset the higher borrowing cost. So the answer for this question is simply what? Simply selling an interest rate future, not buying, not currency option, not a put option on shares. Right? I hope we are clear on this question also. It is purely selling an interest rate future, because buying an interest rate future happens if you're concerned and you're going to get the interest and that the interest rate is going to fall, you'll go buy an interest rate future. If you're going to sell, I mean, if you're going to make a payment of interest in the future and you're concerned that interest rate will go up, you'll sell off right now, later purchase back. That is the hedging technique that we have to consider. Option A, everyone. Right? Let's move to the question number 13. of your section A. So, what is the one that they're talking about? Shia's company has the following information about its financing available: minimum cash balance of $10,000, and variance of daily cash flows will be 2.5 million. Transaction cost is $20 per switch, and daily interest is also given. Guys, if you all know, we have using the spread, using the Miller ORR model that they are asking you to calculate what? You to calculate what is the shares company's spread. So if you guys know, how do we calculate spread? So all of you guys go to your formula sheet. If you don't know the formula, so go ahead and check what is the spread formula. This is the spread formula. See guys, ACCA is not difficult as long as you know how to handle this. So yeah, so if you take the scratch pad, now I will just apply the formula here. What is the formula that I have to consider? I have to take 3 multiplied with 3 into 3 by 4 of what? Of transaction cost. Now what is the transaction cost that you can all see? It is $20. It is $20 multiplied with, what is the next thing that we have? Variance of cash flows, which is also given. So variance of cash flows will be somewhere around 2.5 million. Guys, take the whole value because the question is taken on the dollar. This, whatever you get, divided with daily interest, that is 0.03%, and whatever the answer that you get, you raise it to 1 by 3. This is the formula, isn't it? If you guys can go ahead and check, this is the formula that we are talking here. Now, whatever you get the answer from this, that you will go ahead and multiply with what? That you will go ahead and multiply with 3. That is the spread part. Now, I'll close the formula sheet. Open what? Open the calculator. Now, guys, for the inside value, use the regular calculator. What is it? It is 3 divided by 4 into 20 into 2.5 million. Yeah. So, this divided with 0.03%. So 2000, 1250. Now what you have to do, write the answer 3 into 1250. So but this 1250 has to be raised to the power, to the power 1 by 3 is what we have to do. Now ma'am, how do I do it in the standard calculator? Guys, if you're finding difficulty in your regular calculator, what you can do, you can convert into scientific. Yeah. So you can convert into scientific. So how do you do it? You'll go ahead and take 1250, yeah, and go ahead and raise it to the power here 1 divided by 3. So you should get what? Somewhere around 10.772 or whatever the value is, that multiplied with 3. You should get an answer. Now ma'am, what if we are not able to, get the answer this way? See, I'll tell you one best option, guys. Yeah, I will tell you one best option. So what will I do? I have this scratch pad. Correct. I'll give you the best option. Don't get confused. Because this is what I do. I'm not so great with calculators every time. So I will go to this spreadsheet here. I know the formula. What should I do? I should go ahead and take 3 multiplied with, open 2 brackets, 3 by 4 into 20 into the variance is 2.5 million. 2.5 million divided with 0.03%. Close the bracket. Raise to the power 1 by 3. Close 2 brackets. You should get 15,000. Got the answer. Over. See, you can always cross verify your answer here. So the answer is simply $15,000. You do not have to sit and worry about it. The answer is simply what? $15,000, and write the whole answer, guys. I hope we are clear on this. Why do I use spreadsheet every time? Because we get confused using the calculator. Ma'am, I'm really good at calculator. I'm so happy about it. Somebody who's not good at calculator, use this simple technique. Go to navigator, go to that question which has spreadsheet. Don't bother about what answers are there. Use that spreadsheet formula so that you'll be able to get this answer simply. So that it will not take much time for us. Getting? Now, let's move to the next question. What is the next question talking about? According to pecking order theory, which of the following is preferred order of financing? Just close your eyes and write. It's always retained earnings, debt, and new equity. That's all. There is nothing else. First, I will go with the internal finance retained earnings. If not, I'll go with the cheaper option of debt. The last option is always new equity. So the answer has to be simply option B. Don't waste your time on this too. Right? Let's move to the last question of your section A. A project has strictly limited capital of 1 million in year 0. So what topic are they even trying to assess here? They're talking about the capital ration. The project A has an outlay of $600,000, NPV of 150. Project B, outlay of 500, NPV of 130. Project C, 380, NPV of 85. Project are divisible, but project B and C are mutually exclusive. Tell me what is the maximum NPV available. Guys, if you have to consider the capital rationing, so you should know if it is projects are divisible, you have to calculate something called profitability index. To calculate something called what? Profitability index. Now, what is this profitability index, guys? I'll take NPV divided by initial investment. NPV divided by initial investment. So if you take project A, so the project A has an initial, don't waste your time. Take your calculator. You already have the information here. Don't sit and waste your time, or use your personal calculator that you carry to the examination. So what is the initial investment? I mean, what is the NPV that you're getting from the NPV of $150,000 divided by initial investment of 600? Your profitability index is 0.25 here. And then project B. How do you do? Once again, take the same values. $130,000 divided by initial investment is 500. It has a profitability index of how much? 0.26 now. And then project C. How much is my profitability index? So I will go ahead and consider $85,000. Just take 85 divided by initial investment of 380. That should give profitability index of 0. Somewhere around 223. If you round it off, it has to be somewhere around 0.23. Now, guys, I will go give the ranking. This is rank 2 and this is rank 1. And this is rank. I will not even bother about rank 3 now. Why? Because you understand project B and C are mutually exclusive. I will choose project A. Correct? What do? I will go ahead and choose the project A. So why project A, guys? Of course, we have the initial amount. So I will go ahead and invest in all of the, don't say, guys, see, understand, I will go invest, I will choose project B, and with an initial outlay of how much? Initial outlay of $500,000, because that is the rank 1. Creating an NPV of how much? Creating an NPV of $130,000. I'll go project A because of course I can't choose project C because it is mutually exclusive. See, I have only 1 million. Only the remaining investment I will go ahead and do. So how much is that? That is remaining $500,000, which doesn't create the whole NPV of 130, guys. It will create only, see, I am investing 500 of what? 500 of 600. So what is the percentage I'm investing? Only 83%. So only 83% of the total NPV also I might go ahead and calculate. That is of how much? That is of $125,000 approximately. Right? So what is your total NPV that you will be making? The total NPV is project B creating an NPV of 130, project A creating an NPV of only 125. Together, if you take, it has to be how much? It has to be 125 plus 130, $255,000. So the answer has to be simply option C. Such a simple question, just that they have added more. So answer for this is what, guys? Answer for this is option C, which is very, very simple. So I hope all of you guys clear with the entire section A part. So now if you go to the navigation, see, I will go ahead and go to this, eliminate the flag, because I don't want to review this. I'm very good at it. I mean, I completed and I got the right answers. I will eliminate the flag for review. So if you guys see now, I have to go to the section B part. See, we have taken approximately 45 minutes to complete the whole section A, but provided here I have explained, I'm explaining you guys in depth and all of that. So, but if I do it on my own, maybe I'll take only 30 minutes. Right, in the exam also in section A, you should be able to complete within 30 to 40 minutes, provided if you know all the questions, guys. There are high chances where out of 15 questions, you know 12, after 15 questions, you know 13. Correct. So, what happens? At that point of time, you can only go ahead and spend like 30 minutes per section A. That should be more than enough. If you know all the question, 40 to 45 minutes is still fine. 40 minutes is what I would say. Don't go for 45 minutes. Right? Now let's move to what? Let's move to section B, all of you guys. Okay. So look at the section C. So this requirement or this scenario relates to questions from 16 to 20. So Foley Company is a small unlisted manufacturing company. They have seen steady growth in recent years and all of that. See, I'll tell you, when you solve section B question, don't waste your time in terms of reading everything from the beginning before you solve the first question itself. What I would suggest, always look at what they're asking. Right? What is the value of one share in Foley Company? Using the net assets realizable value method. So if you have to understand this, you should know what is NRV method. Nothing but whatever the value that I can sell it in the market right now, by to sell it, whatever the cost that I incur, that minus my what? That minus the asset value. That is simply what? That is simply the NRV method. Correct? Let's now read the information. So, we are a small unlisted manufacturing company. They have seen steady growth in recent years, making them attractive for larger companies to acquire. Maybe companies are ready to acquire them. A larger listed company, JSTAS PLC, has noticed their strong performance and is looking to acquire Foley Company. So, business evaluation is what indirectly the questions are. So we have the total assets, we have total liabilities. Estimated realizable value of non-current asset is 2 million, higher than the book value. Fair enough. Earnings after tax is $800,000, and we have dividend with the recent history is given. Cost of equity is given, and shares in issue that is of $1 million with the nominal value having overall share value is $1 million, with the nominal value being 0.5, and we have got the PE ratio. Yeah, and since Foley Company is unlisted, a discount of 30% is usually applied to the PE ratio of a listed proxy. If you're going to use income valuation method, then we'll go ahead and apply this discounting for the PE ratio to calculate our share price. Now, if you look at this, first question is only simply that I have to calculate the net realizable value. Because what is net realizable value of each share? All you guys need to first understand is to calculate the net realizable value of each share. First, I need to know what is the total number of shares in the business. Okay. So what is the total number of shares that we can see in the business? See, the total number of shares are nothing but, I have $1 million shares with the nominal value being how much? With the nominal value being each share has a value of $0.5. So that means I should have 2 million shares overall. This is number of shares. Now I need to find out what? I need to find out NRV of equity. So what is NRV of equity? It is nothing but I will take is equals to NRV of total assets minus liabilities. Correct? So now it's just the normal equation that we use, but we use NRV. Now if you see, the book value of the asset is 8.5 million, but the estimated realizable value of non-current assets is actually 2 million higher than the book value. So here, if you have to consider, do I have to consider the entire 8.5 million only, or do I also have to add 2 million? The total value of the business or the total value of the assets is not limited to 8.5 million of your net asset value. It is 8.5 plus 2 million. Overall, 10.5 million is the NRV of assets. And this will be reduced with the liabilities value. What is the liabilities that you can see here? The liabilities having a value of 3.5 million. So the NRV of total equity would be 7 million, and that should be divided by the total number of shares. So if you take total number of shares, that is 2 million. Each share NRV shall be of how much? It is of 7 million divided by 2 million, guys. You can take your calculator if you want. It is going to be 7 upon 2. Yeah, sorry. 7 upon. So the answer has to be simply $3.5. So option B should be the right answer for this. Right? This is regarding what? This is regarding the question number 60. That is first question of your section B question. Look at the next one. Calculate the total value of Folly company using a dividend valuation model to the nearest dollar. Guys, what are they asking? Using dividend valuation model, find out the share price. So first of all, what is the formula? If you have to find out the P0, that is share price today, this is nothing but D1 divided by cost of equity minus growth. This is what? This is the value that I'll find out the share price. And once I find out the share price, I can multiply with the total number of shares. Now, what is D1, guys? First of all, do we have growth? Growth is something that I have to calculate. What method do you think I will have to go ahead and calculate? I'll calculate using historical method. Why historical method? Because there are certain information which is already has given. Yeah. So if you can see in 20x3, our dividend is how much, guys? Our dividend is 20x3, our dividend is 330,750, correct? Yeah. And 20x1, that is 2 years ago, our dividend was how much? Our dividend was $300,000. Yeah. So you can use historical method to calculate what? To calculate the growth rate. So how do we do? If you guys do know the formula is nothing but D current dividend, that is D right now. Is nothing but D right now. D0 is D right now, divided by D n years ago, that is 2 years ago. This, whatever you get, this raised to the power 1 by 2, that is 1 by n, and whatever the answer that you get, whole minus 1. So with this help, you'll be able to get what? You'll be able to get D. Now, ma'am, how do I do it in my, again, guys, go to the navigator, straight to the spreadsheet question. Use this, you know the information already. So what is D right now, guys? D right now is 330,750. D n years ago was $300,000. This will be raised to the power of, open the bracket. Whenever you have 1 divided by n as the power value, you should always open and close the bracket for this. And whatever I get on this, I minus 1. Yeah. So my dividend, my growth rate, if you convert into percentage, it's going to be 5%. My G will be how much? My G will be 5%. Yeah. What is cost of equity that was given in the question? Maybe you can go back and find out. But since I have that photo memory, I can tell you that the cost of equity on that question was somewhere around 10%. So you can use the same spreadsheet to find out your share price directly. So how do you do it, guys? What is the dividend valuation model? Use this formula. So right now you have D, dividend right now is how much, guys? 330,750. What do you think the dividend 1, D1, that is after 1 year, will be? 330 into 1 plus 5%. So you shall be getting 347288. Now use this formula. It is nothing but 347288 divided by what? Divided by cost of equity is 10% minus 5%. So that is the value of your total equity. Guys, you don't have to take it as 1 by 1. Just take the total value. So D1 shall be what? D1 is calculated using D0, that is 330,750 multiplied with 1 plus G. What is G? That is 5% that we have calculated, right? So that should give us what? That should give us 3472887.5 approximately. Right? Yeah, approximately. That is the value. And then you use this. So what is D1? Take the total dividend. It's totally fine. 347287.5 divided by cost of equity is 10 percentage minus what? Minus 5 percentage, and that should give you a value of 6945750. This is the total value of equity. Correct. Go back to the question, guys. So since it's a fill in the blanks question, you have to be very clear. That's the reason I've used the spreadsheet, and you guys also please use the spreadsheet for that point. So what will be the answer? It is going to be 6945750. Exactly. Don't put comma, nothing. No commas, nothing. Just write the exact answer. Don't put dollar, don't put values. Fill in the blanks. Whatever that you get, simply you have to apply that. Don't put anything else. Don't put commas and all of that. 6945750. That's it. Right. So that should be the answer. Right. Let's move to the next question, everyone. Let's just restore the Wi-Fi, guys. I think that should help us move forward. Right. So let's go to the next question. What is the next question even talking about? So the next question is yep. So the next question is talking about what? The next question is talking about which of the following statements best explains why Gestas PLC would prefer to use an earnings based valuation method or a net assets method of value of folly company. See, the net assets method is more complex to calculate and often results in higher valuation. Could be. Guys, if you see, where do you think it's best explained? See, understand, net asset method is not complex to calculate. It's very simple. But it will not show a higher valuation, rather, it might show a lower valuation. That is a problem. Because sometimes maybe your shares could be more than what you have it in the market, what you have it in the book value. Right? Yeah. And acquiring, if you have to buy for your future income streams, it's better to follow PE method, but understand the price earnings method is governed by accounting standards, making it more reliable for tax purpose. See, I can, but there is nothing like price earnings ratios is actually getting governed. The PE method is more of a earning potential of the target business, which aligns with the synergy benefits the acquirer aims to achieve. So that's the reason I follow PE method for some company who startup. Correct? Yeah. It's not because it is governed by accounting standards. No accounting standards are governing a PE ratio. And in first of all, finance may there is no accounting standards, guys. Right? And net asset method is applicable for companies that are being liquidated or broken up. Maybe we don't do that, right? It is more of a present value future cash flows that we do. At that point of time, it goes up. So to be honest, the right answer for this question has to be what? The right answer for this question is option C. Yeah. Now look at the fourth question, guys. That is 19th question. What is the value of Foley company's equity using the PE method adjusted for the unlisted company discount? Guys, first calculate your price earnings ratio. Foley companies PE ratio. How do you calculate? We have to take the price divided by earnings, and that will be what? That will be the PE ratio. Now, we have proxy PE ratio. What is the proxy PE ratio that we have? That is nothing but 15. But to this, apply a discount of how much? Which they have clearly said discount of 30%. That means the PE ratio that I can use will be nothing but 70%. That is 15 into 70% is what I can go ahead and use. So how much is that? Use your calculator once again. So 15 multiplied with what? 15 multiplied with 70%. So 10.5 is what you have to go ahead and use. So 10.5, yeah, with the help of your PE ratio, if you need to find out the price, I can reverse the formula saying that earnings multiplied with PE ratio. So we have just got what is the earnings after taxes? $800,000. This into $800,000. This is the total value of equity, which is of how much? Which is of 8.4 million. So what is the value that you will take? The price, if you have to consider, the total earnings are nothing but $800,000 multiplied with the discounted price earnings ratio that we will be using is how much, guys? That will be using is 10.5. That should give the value of 8.4 million as the total company's value. This should be $8.4 $8,400,000. The answer has to be simply option A. I hope we are good. Yeah. Sometimes it happens. What is the next one? An investor performs fundamental analysis to make investment decision. Which form of efficiency do they believe the market has? Guys, big form efficiency. Because if you perform a fundamental analysis, the investors believe the market should be efficient in some way. But yeah, has not yet reflected this information, making it more weak form, isn't it? Correct? Yeah, because if you take this company, what is semi-strong, guys? It is like in publicly there are information which is available which can reflect in the share price later. But here the company is completely unlisted, so this considers as what? This considers as the market were not efficient. There won't be no value doing in any kind of fundamental efficiency, right? So it is more of a weak form efficiency. Why? Because I have not any information that is reflected in the market yet. So the answer for this question has to be what, guys? Weak form efficiency. No information, weak form. Slight information, semi-strong form. So that's the first question of your section B. So sometimes what happens, ma'am, I have a doubt, flag it and keep it. So you can always go ahead and flag it and keep it. So flag for review, you can always keep it. Now we'll move to the next sort of section, B questions, guys. Okay. Hey, top company. Again, you have to first read the requirement and then go ahead and read the what? Read the information which is given here. So what are they trying to say? What is the economic order quantity for Hey top company to the nearest whole unit? Now read the information. Hey top company manufactures electronic components. It is reviewing its inventory management policy in order to support the board's recent request to reduce its overall cash operating cycle. So, one approach discussed in a recent meeting is to switch to a more just-in-time policy of inventory, which would make move away from HATOP's current approach of holding high level of inventory. Of course, GIT is something I want to keep the low level of inventory so that less number of holding cost. But always it also reduce of what? I mean, it might have a risk of stock out too. And the finance director has expressed concern about HATOP overtrading and how to identify this before it becomes a bigger issue. Currently, HATOP places orders for raw materials of 50,000 units per month. The cost of placing an order is $200. The holding cost is 0.5 per unit. The purchase price is $10 per unit. And supplier also have offered a bulk discount. So I'm sure there could be a question about bulk discount. I'm sure there could be a question about lot of factors now. Correct, guys. So let's start with the first one, EOQ. What is the formula of EOQ? Open the formula sheet. What is the formula of EOQ? This is EOQ. It is nothing but the square root of Hey, why is it on? Yep. Formula sheet, if you see, this is nothing but square root of what? Square root of, oh, okay. Fair enough. Sorry. Okay. Take your scratch pad and just write the formula if you want, or you can use directly that way. It's going to be square root of 2 multiplied with cost of holding multiplied with demand divided by, cost of ordering multiplied with demand divided by cost of holding. So 2 into what is cost of ordering is, every time you order, you are incurring $200. And the demand is, see, I'm ordering 50,000 units per month. So that means my total demand is how much? 12 months ke liye. I might go ahead and consider how much? 50,000 units into 12 months. That'll be somewhere around 6 lakhs. That is nothing but 600,000 units. That will be the total demand. Correct. So take the demand is how much? 600,000 units divided by cost of holding per unit is how much? On an average 0.5 everyone. So you have to apply the same thing in the Excel. See, again, don't waste your time. Go to a quick section C question spreadsheet. Use that spreadsheet to calculate an answer on this. Is equals to SQ RT of 2 into 200 into $600,000 divided by 0.5. It's okay, guys. You can do it in the regular also. So what should be the answer for your value? It has to be somewhere around 21,909. So to the fine dollar you have to bring, right? $21,909. If you can see, we have the exact answer. Go ahead and consider that as your answer. 21,909. Fair enough? Yeah. Look at the next question. Let me take this away. Look at the very next question, guys. What is the next question talking about? Which of the following best describes the primary objective of successfully reducing the length of the cycle? Successfully reducing the length of the cycle. So first thing is maximize sales by offering more generous credit terms to customers. More generous credit terms will increase the receivable days, which will actually increase the overall working capital cycle. No. To increase the company's liquidity by converting all non-current assets to cash. No, guys, lengthening the cycle is dealing with receivables, inventory holding period, and receivables, payables. Now, look at option D also. To ensure the company can eliminate its buffer inventory entirely. That could be, I'm not saying no, but look at option C. The option C, to minimize the external finance required to fund the day-to-day operations. So, I mean, if you reduce it, they're not asking the cost to reduce it. They're asking what happens after reducing it. If you reduce it, you'll have more cash to fund your internal operations instead of you going and take a loan of overdraft. So the answer has to be option C. Right? Yeah. Let's move to the next one. What is the next one talking about? What is the net financial effect of accepting the supplier bulk purchase discount offer of 0.5% for orders of 80,000 units compared to the current policy of ordering 50,000 units? Don't do EOQ part. They're asking right now, what is the value? For that, you need to understand what is the total cost. The total cost has to be calculated. First thing is for 50,000 units. So if you take 50,000 units, first thing is how much is the purchase price, guys? The purchase price will still be, I will go take purchase 600,000 units and each unit will cost me $10. It is going to be approximately how much, guys? Approximately 600,000 into $10. It's going to be 6 million. What is the cost of ordering? The cost of ordering shall be, I will order 50,000 units. That means I will go ahead and consider how much? I will go consider ordering 12 times in a month. So 12 orders multiplied with what? Multiplied with each time I order, it is going to incur $200, guys. And that should, 12 twos are, that's going to be 24,000. Yeah, that's going to be somewhere around 24,000 if I'm not wrong. Right. Next things comes what? Next things comes the holding cost. How do you calculate holding cost? Based on the average inventory, guys. Okay. So holding cost is calculated based on average inventory. So holding cost is calculated using average inventory. multiplied with cost of holding. That has to be nothing but how do you calculate average inventory, guys? Average inventory is calculated by taking 50,000 plus divided by 2. So it's going to be 25,000 multiplied with 0.5. So that shall be somewhere around 12,500. So what is the total cost, guys? The total cost will be 6 million plus 24,000 plus 12,500. The total cost in terms of 50,000 units has to be put together. We do the calculator. It's going to be 6 million plus 24,000. Guys, is it 24,000 or 2,400? 12 into 200. Okay, it's 2,400. My bad. And here I'm sure I'm right. So 6 million plus 2,400 plus 12,500. This is the cost. 6 million 1,4,900. But if I take for 80,000 units, taking everything else same. So for 80,000 units, first, what is the purchase price, guys? The purchase price will be $10, but I am expected to get a discount of 0.5%. So I will be only paying 99.5% of this. So which will typically give me a cost of how much? $600,000 multiplied with 6 million multiplied with 99.5%. So I will end up spending only $597,000 on this. And what is the number of orders? See, 600,000 units. Every time I order 80,000. That means I will go ahead and consider only 7.5 orders. 7.5 orders multiplied with 200. I will spend only 1,500 in terms of what? In terms of ordering cost. But here now the average inventory turns to what? 80 divided by 2, which will become 40,000 multiplied with 0.5. So 40,000 units multiplied with 0.5 will become how much? 20,000 as the total holding cost. So take all of this and calculate what is the total cost. It's $5,970,000 plus 1,500 plus 20,000. So the total value has to be, the total cost has to be 5,991,500. So considering the savings, what is my net savings? I have saved from 6,14,900 to this amount. You're saving how much? A net benefit of 23,400. So the answer for this question has to be simply option C, net benefit of 23,400. Right? So the option is option C. I hope all of you guys clear on this question too. Let's move to the next one, guys. Such a simple question. Which two of the following are the typical symptoms of overtrading, guys? So the typical symptoms of overtrading is two things: increase in sales revenue, increase in trade payables. It will not increase the current ratio, no high cash balances. In fact, it will have low cash balances, because overtrading is like you're overutilizing stuff, right? Yeah, overtrading is nothing but undercapitalization. You do not have enough current assets. So the answer has to be simply A and C. Rapid increase in sales revenue and increase in trade payables. Okay. Now let's move to the next one. A top company uses just-in-time inventory system. Which of the following statement is true regarding JIT? It increases holding cost. Guys, more inventory, more holding cost. JIT is about less inventory. Now, it shifts the responsibility for quality control largely to the supplier. Yes, guys, because you can't rely on somebody who's supplying poor quality, and that can stop the whole production line. So I need a high reliability from a supplier on especially high quality supplies. The answer has to be option B, but let's also see C and D. It reduces the reliance on strong relationship with the suppliers. No, it actually increases. And it is more suitable for companies with unpredictable and fluctuating demand. No, it is actually less suitable for those people who are not able to predict their cash flows or demand every week or a day. So the answer has to be option B, simply. This is between the section B question of the second question. I hope all of you guys are clear so far. We are clear so far. So the last 5 questions of your section B shall be based on, oh, we have a risk management question. Guys, I've always seen in section B, they either give it on risk, business valuation, working capital. Out of these three, two is always there. So concentrate on these three more. Because investment appraisal or most likely asked in section C. So they know that yes, we have certain chances where we can ask risk management and business valuation in the section B part. So it's very important for us to understand those two topics. Very important. Let's move to this. So what is the first question? What type of currency risk is forward company facing regarding the specific receipt? Let's read the information. So what is it saying? US-based Harvard company expects to receive 2 million euros in 3 months' time from a European customer. The finance director is considering hedging this transaction in order to reduce the risk of adverse transaction rate movements. Guys, 3 months, short term. I'm worried about like what if goes up or down. Don't waste your time. It is simply transaction risk. Yeah, if it is a subsidiary coming into the picture, I understand your problem, ma'am. Is it translation risk? No, it is about me worried about what happens in the next 3 months, short term in nature. So transaction risk is what? Transaction risk is more of what if there could be an unfavorable changes because of the movements in the exchange rate. So without wasting your time, you can close your eyes and put that as transaction risk. But read now. Or Harvard company is considering using, guys, don't get worried, ma'am, it was especially with political changes coming up, then political risk. No, me having an unfavorable changes because of the exchange rate movements, it is simply called as the transaction risk. Forget about not exchange rate movement, because of anything I might have to pay more or I might have to receive less, we call it as transaction risk directly. Don't waste your time on that. Yeah, look at the next one. Harvard company is considering using a currency future contract to hedge 2 million receipt. However, the contract expiry date and the date of the cash flows do not match exactly. And we've also suggested consider using options as they can be as far more beneficial than the other hedging products. The following information is given with the forward rate. So they're asking if you have to go with the forward hedge, what is the dollar value of the receipt? What is the dollar value of the receipt, guys? You guys tell me, do I have to take the highest value or lowest value here? So they have given the spot rate, but don't use the spot rate. 3 months forward rate is what you have to go ahead and use, guys. So here I will go ahead and I will give euros at that. After 3 months, I will give you euros. You have to give me what? You have to give me dollar. You will give it to whom? Bank. Will bank collect more euros from you, less euros from you? They'll take more euros from you, because bank is also a finance institution who are running a business to make profit. They'll take more euros to give a dollar to you. So I will have to use 0.8790 as the exchange rate to use to calculate how much is the value of dollar value of the receipt at that point of time using the forward hedge. So that is going to be, I'll get 2 million euros, but I will have to get in dollars by using an exchange rate of 0.8790. So you divide with, you should get 22753,313. The answer is simply option A, guys. Ma'am, when do we divide the currency? When do we multiply the currency? Guys, understand, here euro is the weaker currency. Dollar is the stronger currency. You need to find out the stronger currency, you have to divide with. You need to find out the weaker currency, you should always multiply with the exchange rate. Keep that in mind. The answer for this question is simply 2275313, guys. I hope all of you guys are here. Now let's move to what? Let's move to the the next question, which is talking about what? Which is talking about the risk pattern, right? What type of risk arises from this misalignment between the exposure date and the future contract expiry date? Guys, is it credit risk? No. Liquidity is no. Counterparty? No. It is purely basis risk. The difference between the spot rate and the future price, that is basis, does not predictably towards the expiry date. So that we call it as what? That we call it as basis risk, guys. Yeah, because the future, they're telling we are not getting exact date. You might have to go ahead and sell your future before itself. Because of this, you can expect to have basis risk coming into the picture. No credit, no liquidity, no counterparty. Please, all of that we have never read. And what is the dollar value of the receipt using a money market hedge to the nearest $1,000? Guys, if you do money market, what will you do? Let's first understand what is money market. If you have to set up a money market for the same one, say I'm going to receive 2 million euros in 3 months' time. So what will I do? I will go borrow, I will go borrow some amount, euros, right now. How much I will be borrowing, guys? See, understand this is a proper money market hedge that you have to set up and tell what is the value. So what happens? I will borrow in euros, which is lesser than what? Which is less than 2 million. So that after 3 months, after 3 months, using the receipt of 2 million, I can settle the bank loan. So now that means how much do I have to go ahead and borrow? The amount to be borrowed shall be use the cross multiplication to find out. See, if I borrow, I will have to pay 2% interest, annual interest. So if I 2% annual interest is what I might have to borrow. If you take for 3 months, it is going to be somewhere around at 0.5 percentage. 0.5 percentage. So if 1 plus 0.5 percentage is 2 million euros, how much is 1? 1 will be how much? You can do the cross multiplication, guys. Take the calculator. All you have to do is take 2 million euros divided by 1.05. 2 million euros divided by 1.005. So you have to borrow today how much? 1,990,049 bucks. So I have to borrow 1,990,050 €50. This is what I have to borrow. So that afterwards, you can go ahead and add that 0.5 percentage. This value 1,990,050 multiplied with 0.5 percentage. You'll get 2 million euros, people. So I shall borrow this much. Now, I will borrow. Once I borrow, I will have to go ahead and convert to dollar today itself using a spot rate. Once again, you'll have to now, if you go to the bank will tell us like, okay, you have to pay me more. Give me more euros to get a dollar. So I will have to convert. Now I have to find out the stronger currency. You have to find out the stronger currency, divide with, guys. Yeah. So this divided with the current exchange rate, the stronger exchange rate will be this value. If you use this, you shall get what? You shall get the dollar value. So that will be 199,050 divided with 0.8840. I shall get, why the answers are different? 199,050 divided with 0.8840. That should give you in dollars value how much, guys? In dollars value, it is going to give us 2251,188. This is the value. But don't write this answer same. No. After 3 months, how much it will be? What will you guys do? You will not keep this quiet, right? You will have to go ahead and invest somewhere. This has to be invested at a rate of how much? At a rate of, what is the deposit rate of US, guys? 3%. And after 3 months, it will be earning an interest of how much? Earning an interest of 2 to 5. Don't write your answer. There is no answer of 2 to 5 one also. 2 to 5. 11,188 multiplied with, if you take 3 months interest, I'm sure somewhere it is 0.75 percentage. So 1 plus 0.75 percentage for 3 months interest should give us the value. So take the calculator. It is 225,1188 into 1.22 2251188 multiplied with 1.075. I think it's 1.0075. 2251188 divided with 1.0075. The answer for this question has to be somewhere. I hope I'm right. Again, I'll do the calculation, guys. 2251. So 1 point, is it 1 plus 0? Oh, yeah, it's correct. My bad. 2251188 divided with 1.7. Yeah, 1.075. Don't take 0075. Ah, 1.1 plus, okay. Guys, how much? 1 plus 0.75 percentage is, it's going to be 1.0075. So you take 2251188 divided with 1.0075. Should give me, am I doing some mistake? Let's go to check it out here, guys. Sometimes it happens. Oh, you have to multiply. Sorry, I am dividing with. Oh, I'm sorry. It's my bad. Yeah, exam pressure. I'm also having exam pressure, that just like you guys. So take the calculator here. It is 2251188 multiplied with 1.0075. So it should get 2268 somewhere. So I think the closest answer is first option A. Sorry guys, it's my bad. Chalo, let's move to the next one. What is the next one that we have here? The next question is talking about the 30th question. Which of the following is the main advantage of using an option over a forward contract? It is definitely not cheaper to set up, but it allows the company to benefit if the exchange rate moves in its favor. Yes. It's legally binding, not cannot be cancelled. No, it can be cancelled. And if it fixes the exact rate today, removing all uncertainties, it could be either option B or option C. But for me, I would say option B is the more right answer because it helps you. What if the exchange rate moves in terms of favor to yourself? There is high chance where we might go ahead and not exercise the option. The answer is simply option B. We are good with the entire first set of MCQs of 60 good marks. Now, let's move to the section C part of the question, guys. Mock guys. Let's look what kind of questions we have it in section C. See, the first question is simply NPV, guys. Like investment appraisal is one of the most tested topics, especially when you have financial management, like in section C, one of the most tested topics, always the important question, the 12 marks question. So if you can all see here, the question is calculate the NPV of the proposed investment, comments on its financial acceptability for 12 good marks. Now read the information. Valios company is a profitable company that it is considering a new project to manufacture a new product called V Pro. The project requires an initial investment of 1.2 million for new machinery, which is payable immediately. And this machinery is expected to have a 4-year economic life, after which it will be sold for a scrap value of $200,000. For the tax purpose, right? For the purpose of tax, the company pays corporation taxes 20% with payments made in 1 year arrears, and we can also claim tax allowable depreciation on that investment at 25%, reducing balance method. With any balancing adjustment will be happening at the disposal of assets. Fair enough. Sales are projected to be 10,000 units in the first year and are forecast to grow by 5% annually thereafter at a selling price of $150 per unit, inflating at 3% per year. Okay. And we have contribution is forecast of 60% of sales. I think in that we can easily calculate contribution. Fixed costs are expected to be 250 per year in current terms, inflating at 2%. And this also includes $100,000 of centrally allocated overheads to cover the head office cost. Because if you remember, or if you would have ever studied, there's a concept called what? There's a concept called relevant cash flows. So where in the relevant cash flows, out of $250,000, only 150 is relevant because 100 is centrally allocated. Something allocated or apportioned, I can't consider that. Fair enough, right? So I'll only consider 150, not 100, the part which is allocated. And second part is we use a real cost of capital of 8 with the general inflation being 3.7%, but we are concerned that the cost of the initial investment may change. So I've also asked sensitivity analysis to perform to help make a decision on B Pro project. First, the requirement is about what? The requirement is about calculation of NPV. See guys, first I will do certain working notes so that I can calculate what? I can calculate my NPV. The first working notes that I'm going ahead and doing is, the first one that I'll be doing is my sales. It's very important. The project life is how many years? The project will be having a 4-year life. So that means year 1, year 2, and then year 3, and I will also have year 1, year 2, year 3, and also I will have what? Year 4. Now, what is the number of units that you can expect to have? So number of units that I'm going ahead and considering is number of units right now. See, I'm going to have 10,000 units in the year 1, but it is going to grow at what percentage? Number of units is so and so, but it is going to grow at 5% per annum. So that means in year 2, it will be 10,000 plus 5%. So you can take 1 plus 5%. And in year 3, it is going to be this and this. So you can easily drag down the options, everyone. Keep it at the center. Number of units over. So now, what is the selling price? Selling price in current terms are, if you take year 0, we have a selling price of how much? We can all see the selling price is $150 in current price term. But you have to go ahead and add what? You have to go ahead and add inflation of how much? Add inflation of 3% per year. That means in year 1, it is not 150, it is rather 150 into 1 plus 3%. Correct. In year 2, it is on 154.5 plus 3%. Correct, guys. And you can go ahead and drag it down. Ma'am, can we do compounding? You can do compounding also. Ma'am, can we do this way? You can do this way also. That is totally up to you guys. Right. So once after that, you can find out the total sales that happens every single year. It is going to be 10,000 units multiplied with this value. Yeah. And number of units into respected values of that particular year. So 154.5, it's $1,545,000, and it goes on this way. These are all my sales. Now sometimes what happens, people do calculate in $1,000, but I would suggest you to do it at the full value. So once we are done with sales, the second one is now I will have to go ahead and also calculate contribution directly. So contribution is nothing but 60% of sales. So in year 1, $1,545,000 into 60% will be my contribution. And it goes on. What is contribution, guys? Contribution is nothing but sales minus variable cost. Contribution is nothing but sales minus variable cost. Fair enough. And then comes the third working note. I will go ahead and calculate the fixed cost. So now when I talk about fixed cost, I know it is something that you can't take the whole value. Only $150,000 is relevant because $100,000 is centrally allocated. Only $150,000 out of $250,000 is relevant because the remaining $100,000 are centrally allocated. So we can't consider the remaining value. But however, only $150,000 is included. But you should also understand it is because it's in current price. You should also understand there is an inflation of 2%. So what will you do in year one? It is not $150,000. It's rather $150,000 into 1 plus 2% of inflation. And in year two, it is on this again 1.002. Correct, guys? And it goes like this. These are all my fixed cost. Right? Yeah. Now keep that in mind. This is a negative symbol. Why negative symbol? Because it's a cash outflow. You have to keep it in mind. You have to keep it in mind. So I'll custom it and keep it. Right? Okay. After this, fourth working note, I might find out the tax savings on tax allowable depreciation people. How do we do it? Very simple it is. So you guys need to understand what is my tax written down value and what is my tax allowable depreciation and what is my tax benefits, and you should also know the timing of cash flow. This is how you have to find out. Now in which years? Take all the years. Year 1, opening balance is $1,200,000. The tax allowable depreciation is based on what? It is based on 25% reducing balance method. So this multiplied with 25% is my tax allowable depreciation. My tax benefits is at the tax rate of, how much is the tax rate in this question? If you can see, guys, tax rate is 20%. Can you all see? Guys, always highlight, ma'am. What if we can't find it? Guys, highlight. It's very important. So, corporation tax of 20%. They've given an option to highlight. Highlight it and keep. This is the initial measurement. Highlight it and keep. Yeah, and 25% per annum on a reducing balance method. Highlight it and keep. These are all the things that you need to highlight it and keep when you're doing the calculation. Yeah, it is 10,000 units with a grow at 5%. Highlight it and keep. And $150 and plus increases. Highlight. Contribution. Highlight. Because that is all required, no? And then fixed cost, this part, whatever is required, relevant, please highlight it and keep somewhat the other way. Now the tax benefits will be on $300,000. 25% will be my tax benefits. And the timing, it will happen in T2, that is year 2, because tax payments are paid in arrears. 1 year arrears. Likewise, now go to year 2, guys. Your tax written down value is this minus this. But on this, once again, I'll take what? I will take 20%, 25%. That shall be how much? That shall be that shall be that shall be $225,000. Here also you can go ahead and drag it. And timing will be just drag it. Be careful when we use the spreadsheet. It's very not user friendly. And year 3 again, I'll have a tax return on value. Just drag it, guys. It is $900,000 minus 225, which is nothing but $625,000. On this 25%, that will be your tax allowable depreciation. This should give a 20% tax benefit of 4,121, somewhere around 888, and the tax benefit is T3, T4 may tax cash flow happens. But if you go to the T4, fourth year, I would sometimes not, most likely I would not tell the students to go ahead and calculate for what? Calculate for year 4. Rather, you go less what? Less the scrap value on directly here. How much is the scrap value? If you guys can see, I'll have a scrap value of $200,000. So whatever the balance is treated as what? Whatever the balance is treated as balancing allowances if it is in positive figure. This is treated as what? This is treated as balancing allowances. So now what will I do? I will directly take the tax benefit on this at 20%, and this happens at T5. This is my working note for what? This is my working note for tax allowances. Is that all? No, guys, because we might also have to do one more working to calculate the cost of capital, because I have to calculate nominal cost of capital. This is done using what? This is done using Fisher's formula. So how do you use the Fisher's formula? 1 plus R is equals to 1 plus I, that is real cost of capital, into 1 plus H. So what is 1 plus R here? That is something that we have to calculate. So 1 plus I. What is 1 plus I, guys? The real cost of capital is 8% multiplied with what? General inflation of 3.7%. That should give us a value of how much you can do is equals to 1 plus 8% multiplied with 1 plus 3.7%. So this plus 1 plus R is equals to what? It is equals to 1.11996. So can I take R is equals to 1.11996 minus 1? That should typically give me a value of how much? This minus 1, and convert into percentage is somewhere around 12%. Guys, you can keep 12%. Don't waste your time. 12%, because it's a section C question. It is not an AB question to get a precise value. 12%. That is your real cost of capital that we have to use it in the discounting rate. See, once you calculate all the respective working note, now I will go ahead and calculate what? Calculation of NPV for the proposed project. So what is the first thing that I might have to consider? The first thing I might have to go ahead and consider will be the contribution. Directly take contribution. Why you don't have to take? Because ultimately contribution is the value that you have to consider, right? Or ma'am, no, I want to show. You can also show separately, guys. So sales coming from what? Coming from working note number 1. So consider this as T0, T1, T2, T3, T4, and I need it till T5. So what is my sales that happens from T1? So give the reference. Don't waste your time. This is my sales. And drag it down. Just have to drag till T4. Job done. And in this, what will you do? You'll go ahead and less variable cost. You can show this also, or you can directly take what? Take the values, which is a 40% of the sales, and drag it down. Once after this, you can find this as contribution, guys. Contribution is any which way that you can either calculate here, or you can say working note number 2. That is totally up to you. So what is it? The contribution has to be sales minus variable cost, which will match with the working note 2 that we have done, or directly start with the working contribution. That is up to you. But after contribution, we should all know, so we'll have to go reduce what? Fixed cost. That is something that we have calculated it. Correct. So what do you have to do? Go less fixed cost. That is coming from working note number 3. Right. So go give the reference directly. That is of how much? That is of 153,000 and thereon. This is my value. Now, whatever I'll get, I can call it as what? I can call it as operating cash flows. That is my contribution minus my fixed cost can give you operating cash flows, and that shall give you where we will go ahead and reduce what? We will go ahead and less a tax of 20% for my operating cash flows and outflow. But it happens in 1 year arrears. So put it on a minus figure, select this value, multiply with 20. See, whatever T1 that you made a profit or operating cash flows, for that you pay a tax in next year. Likewise, it goes till T5. That is the reason we have kept the T5 at the last. Likewise, we should also add tax benefits coming from working note number 5. Is that 5 or 4? 4. So that is something that we have calculated separately. Again, look at the timing. T2 75,000 and T3 56,250 and T4 41 42188 and T5 finally how much? 61,250. So now if you consider all of this, I have one more value, one more thing, scrap value that is given, which is at the end of T4 that I will get $200,000 a positive cash flow. And after all, I will have to consider the initial investment that we make is minus $1,200,000. Now calculate what? Calculate net cash flows. So your net cash flows overall in the business will be the sum of, take from the operating cash flows, guys. Don't mark the calculations properly from operating cash flows. Go ahead and drag it till T5. Over. So now this is my what? This is my net cash flows. In this, what will I do? Now discounting factor at the rate 12 percentage. So what is discounting factor at the rate 12 percentage? Guys, use annuity factor table or discounting factor table. Go here, go to formula sheet, drag it down. All of you guys can see at 12 percentage discounting factor, maybe little bit, yeah, 12 percentage discounting factor, it is 0.893 and 0.797 at 12 percentage, 0.712 and then 0.636 and then 0.567. Fair enough. Job done. This job is done. Yeah, then you go ahead and calculate the discounted present value. Present values. So how do you calculate present value? See, this is already in its present value. Don't calculate once again. Yeah, future cash flows multiplied with the discounting factor, and you do till T5. So these are all your present cash flows. Now what will I do? See, so far whatever we have done is fine. So I have to keep all of this aligning it properly, right? First, before till the discounting factor, keep it in general. It's okay, you can keep it in $1. Yeah, and this one also you can go ahead and keep it in general. Yeah, all of them go ahead and keep it in center if you want. That is up to you. So what is my NPV, guys? The sum of all of my future present value of future cash flows. So the NPV for this project has to be 128. Did I miss anything? I think I missed something, but look at this. See now, because we have gone ahead and give the references properly, what happens? See, I might have got everything right. Let me just cross verify. I think yes, everything is right as far as we have done. So 20 percentage. Oh yeah, somewhere here. No, we have done one small mistake here. It's 20 percentage. So that I have changed to 25 percentage. Yeah, so drag it down. So now if you see, you can go to your NPV, it automatically gets changed. You don't have to do anything. Yeah, because you have given references to each and everything. So when you make a small change, it will by default change the whole value, and your NPV has to be somewhere around 1,263,593. Guys, it's okay if you're getting here and there. It's totally fine. It should not be a big deal. Yeah, but if you're getting so much, that should be the right answer. Okay. Right, so we should get an NPV of how much? 125,4120. That is the changed NPV. See, automatically it gets changed if you have made any kind of mistakes. But ma'am, do we write like this and then get marks? Of course, yes, you'll get solid 12 marks. But if you have enough time, then what you can do, guys, you can go ahead and put a, just maybe you can little format it. But generally, I wouldn't suggest you guys to take all of this time and consider this, because There's always, I know I used to have this option. Right now I can't see that. We have an option to format and go to cells, and you can just put a border, and you can select the border. Once you select the border, you can apply. Yeah, okay. So you got, that's the problem. So I'm showing only one. You guys can do it if you want. Yeah, border. So write it as outline. Once it is, got it. So you can do something like this so that it is each working note separately. But yes, this is the ideal answer that you have to write for the first one. Very simple, very easy. Right? Yeah. Let's move to the next question. What is the next question? They're asking you to calculate the sensitivity of the project to a change in the initial investment and comment on its meaning. 2 marks, guys. So if it is 2 marks, what I would suggest, all you have to do is take, what you have to do, you just have to take these values. Only take these values. So what is these values? See, I know the present value is how much, guys? I know the present value of a project is 1.2 million and NPV is 1254120. So take only these values. How do we calculate the sensitivity analysis of the project? So the sensitivity analysis of the project is calculated using the formula sensitivity analysis is calculated using the formula called NPV, the present NPV divided by present value of relevant cash flow. Here the relevant cash flow is initial investment. Yeah, initial investment. So that means what should I do? I'll take the NPV value divided with the present value of initial investment. So what is NPV, guys? NPV is 1254120. And what is the present value of initial investment? The present value of initial investment is PV of initial investment is simply 1.2 million. So what do you have to do? The sensitivity analysis will be 1.2 million. So what is the sensitivity to the project when it comes to sensitivity? NPV divided by this, and if you convert into percentage, it is of around 104.51 percentage, guys. So what do you mean by this? This means the initial investment should increase by 105 percentage to make the project not viable. That means it has to increase. I mean, 1 to double I have to invest so that the project can go not viable. This would require a huge increase in initial cost. It is unlikely to be a concern. So this huge increase is unlikely to be a concern. Maybe you have to discuss because it is with 2 marks, right? You talk about percentage, that is 1 mark, and discuss, you'll get 1 more mark. Fair enough. That is the second requirement of this question. Let's now move to the third requirement of the question. So the next question is, discuss the benefits and limitations of sensitivity analysis and suggest any other way to assess the uncertainty. Guys, it's very, I wouldn't say simple question, but they're talking about you have to discuss both. What is that both things that you have to discuss with? You might have to discuss the sensitivity analysis card benefits and limitations, but you should also suggest what? You should also suggest any other methods that we have. Okay, so now the point is, Okay, ma'am. What do we talk? I mean, how do we start the answer? How do we write a 6 marks, answer for this? Because first you need to understand what are they actually asking about, right? So what are they actually discussing about? They're talking, right? Tell me what is good about sensitivity analysis and tell me what is bad about the sensitivity analysis, isn't it? Tell me what is good about the sensitivity analysis and also tell me what is bad about the sensitivity analysis. See, first thing is I will go ahead and talk what? I will go ahead and talk the benefits of sensitivity analysis. Yeah, because they discuss benefits. Yeah. First, give an information what is sensitivity analysis. Maybe just a small line, one line explanation if you want to give, you can go ahead and give. So, what is that one line information that we will consider? It is like it is a method for assessing risk and uncertainty in investment appraisal. That's all. Because it is they have not asked you to sensitivity analysis. It is a method. It is a method to assess the risk and uncertainty in investment appraisal. Certainty in investment appraisal, something like that. You can go ahead and write. Now, what are the benefits of sensitivity analysis, guys? The benefits of sensitivity analysis could be of there are a lot of benefits, of course. Like you can write whatever you think is better. See, it identifies the key risk drivers. I mean, it calculates the exact percentage, isn't it? So it calculates the exact percentage. Why am I not able to copy? So identify the risk drivers. First thing, what do you mean by it is identifying the risk drivers? It is about it calculates the exact percentage change in a single variable. Correct? Yeah. What does it do? It calculates exact percentage of change in a single variable. For example, sales volume, scrap value, right? Or fixed cost, etc. Fixed cost. So it gives us what? It gives us exact change, right? Which is required to drop the project's NPV to zero. What percentage of change in a single variable calculates? Which is required to drop the NPV of the project to zero. That is one thing. It's good. I mean, I get to know what exactly the percentage and change that I'm expecting to. That is the first point that I can go ahead and write. What is the next point I'd write? See, of course, the smaller the percentage, you need to make the project unviable. I mean, less percentage, riskier that variable is. That means less percentage will be treated as what? Treated as highly riskier variable. Riskier variable because a slight change can lead to project unviable. Something like this you can write. First point. Now, what is the second point that you'll be writing on the benefits part? Maybe you can also discuss about what? You can also discuss about by pointing out, like, which variables have the greatest impact on viability. Management knows where exactly they have to direct their monitoring efforts, isn't it? Yeah. By pointing out which variables have the greatest impact, which variables have the greatest impact. See, because of this, what do you think will happen? The greatest impact on viability, for example, the management knows exactly where to direct their monitoring efforts. Impact on viability, right? Management knows where to concentrate. Management knows where to concentrate on monitoring effects. I mean, where do I have to go ahead and monitor much? That is something management can lead to do it. See, guys, they have asked 6 marks ke liye. Benefits of, you write 2 points in benefits, you write 2 points in limitation. But however, you can also write one more point. See, understand it is very quick that it requires a basic spreadsheet calculation. Yeah. So you can also write one more thing. Unlike complex models, yeah, sensitivity analysis is a quick basic spreadsheet concept. So maybe it helps us in understanding better way. So that is what, that is benefits. Don't write too much, not required. Now also we have to talk about limitations of sensitivity analysis. What are the limitations? Unlike complex model, sensitivity analysis is a quick basic spreadsheet calculations. So that is something which is very simple for us. Similarly, now limitations of sensitivity analysis. What are the limitations of sensitivity analysis that you think we have to go ahead and do? We can write many points. So in that, the first point could be of maybe one variable at a time. See, it assumes all the factors remains constant while changing just one. Correct? Yeah. It assumes all the other variables stays constant while just one variable changes at a time. One variable changes at a time, which in reality, because in reality we can always see that business variables are interconnected. Reality, business variables are interconnected. That is one disadvantage that we can see. What is the next disadvantage that you can talk about? The next disadvantage that you can talk about is, guys, it is also about, it tells you the consequence of a change. For example, if sales falls by 5%, NPV becomes 0. But it tells you absolutely nothing about the likelihood of that change. I mean, it tells you the consequence but not the probability. It tells us the consequences of the change in a variable, which is nothing but, if you have to give an example, for example, a 5% change in sales, 5% change in sales can lead to project becoming unviable. Correct? Something that you can say. But it ignores the likelihood of the change happening. That is probability. It is something ignoring. So something, maybe you guys can go ahead and write something like that. Yeah. So what do we have? We have both benefits and limitations. I've already written 5 points. Now, ma'am, one more point. Where do I go right? See, give a recommendation. What is the recommendation that you can do? What are the alternative methods, guys? The alternative methods can be Monte Carlo simulation method. Correct? To overcome you'll write something like this. To overcome limitations of sensitivity analysis, yeah, which all the things that we have. So maybe simulation could be more dynamic way to model uncertainty. Correct? Simulation, Monte Carlo simulation could be more dynamic way for modern uncertainty. Yeah. So why do you think this is better? Just give one more line explanation. That should be fine. Because instead of changing one factor at a time, simulation model thousands of random combinations of multiple variables simultaneously. Correct? Yeah. Instead of changing one factor at a time, instead of changing one factor at a time, simulation can accommodate combinations of, or you can say, simulation models, thousands of random combinations. Simulation can accommodate thousands of random combinations thousands of random combinations of multiple variables simultaneously. Of multiple variables simultaneously. You guys can write something like this. See, guys, it should actually give you 6 marks. Solid 6 marks for the 6 points. Ma'am, do I have to write something extra? What if I know extra? Yes, you can write. Maybe I can say, see, because it runs thousands of combinations, it doesn't just give a single NPV figure. Maybe the output is a range of outcomes that statistically likelihood of achieving them. Correct. Yeah, maybe you'd like to go ahead and write something like this. Ma'am, can we also write one conclusion line for this? Maybe yes, you can also write one small conclusion line for this, guys. So what is a conclusion line that you can go ahead and say? To wrap this up, you can choose, like, choosing between a simple low cost limitations model. Instead, you can go for the simulation. But simulation is high cost. That is also there. Okay, but yes, this is enough because the question is very straight and you also straightly answer. We don't have to bother much. This is about the first 20 marks of the requirement. If you guys can see, the first one in this question, we have calculated NPV, 12 marks, then sensitivity, 2 marks, and then the 6 marks for the explanation. Now we will all move to the next requirement, that is the 34th question of your part, which is, yep, we have to calculate the weighted average cost of capital for 12 marks. So if you go to the next one, it is discuss the theoretical reasons why the cost of capital Roper company might change if the company raises significant new finance. So it is about what? It is about the why WAC part. So now first what do? We will go ahead and finish off the WAC question. Let's read the WAC question, guys. What is the WAC question talking about? Roper Company is a listed logistics company. It wants to calculate its current WAC, weighted average cost of capital, to assess new potential investment. Roper Company pays a tax of 25%. And Roper Company has 10 million ordinary shares in issue, currently trading at 5.25 per share, that is cum dividend, and a dividend of 0.5 per share is about to be paid. So here I have 10 million shares where each share is trading at 5.25, a cum dividend price, but we have to calculate X dividend price if we need to calculate any WAC. Right, and we also have 2 million 8% preference shares. Nominal value is $1 in issue, but it is trading at 1.12 per share, and that is completely X dividend. The company has an equity beta of 1.1, risk-free return of 3%, and equity risk premium of 7%. Fair enough, no problem. Now we have long-term debt. Roper Company has issued 20 million book value of 6% convertible bonds. The bonds are currently trading at $105 per $100 nominal value. Interest is paid annually. The bonds are redeemable in 5 years' time at par. The convertible into 20 ordinary shares for every $100 of bonds. The current share price is expected to grow by 4% per year for the next 5 years. Huge information. Let's start the question. So what is that we have to start with? First thing, guys, if I need to calculate the weighted average cost of capital, and that is based on the market value, understand, and it is given for 12 good marks. It is not anything less than 12 good marks. It is good. It is given for what? More than 12 marks. Correct? Yeah. So now if I have to go ahead and calculate the WAC, what is that first thing I need to know? I need to calculate the cost of equity, and I should also calculate cost of preference shares, and I should also calculate cost of loan notes. First, cost of equity. Using what model? Using CAPM model. What is the formula? If you don't know the formula, go to the formula sheet quickly. So what is the formula for CAPM model if you guys can look at it? risk-free rate. This is the formula, if you guys can see, CAPM. Yeah, to find out the rate, what do you have to do? Take risk-free rate plus equity beta multiplied with the required rate of market return minus risk free, which is nothing but premium amount. Market risk premium. So this is the formula. I have everything, guys. All I have to do is my risk free rate is 3% plus my risk free rate is 3% plus my equity beta for this question is 1.1, and the risk premium directly they have given. You don't have to calculate separately. The risk premium is directly given, and that will be 7%. So when you use this in terms of calculation, so you'll have a cost of equity of 3% plus 1.1 of 7%. So that should give you a cost of equity if you convert into percentage. That's going to be how much? That's going to be approximately 11%. Yeah, 10.7% if you have to consider. Now this is cost of equity. Likewise, I have to also find out my cost of preference shares. What is my cost of preference shares, guys? I have to use dividend valuation model. What is the formula? Very simple. Preference dividend divided by preference dividend divided by what, people? Divided by the share price of the preference dividend. What is the preference dividend, guys? We pay 8%. So the nominal value is $1. So preference dividend is calculated. Don't use short forms like me, guys. You have to use the full form. It is 8% of $1. That will be of how much? 0.08 correct. And share price is how much, guys? The share price has to be, they have directly given the share price is $1.12. So use this in terms of what? In terms of calculating the preference shares dividend. 0.08, that is 8 cents divided by 1.12. So what do you think your cost of preference shares is going to be? It is going to be 7.1%. Maybe you guys can keep 7% also, or keep it 7.1%. It should be fine. Then we have what? Then we have cost of. See, guys, it is redeemable loan notes because I have three types of capital. For all the three types of capital, I have to consider. See, redeemable loan notes, I have to use IRR. What is IRR? Nothing but present value of all future cash flows associated with the loan notes. That is what you have to go ahead and consider. So how do you calculate the present value of all future cash flows associated with the loan notes? So very simple. One is interest payments. But interest payments after tax is what we have to consider. How much is it, guys? We pay an interest of, see, 6% of coupon rate. 6% of coupon rate into $100 to be assumed as your nominal value into 1 minus tax rate. What is the tax rate, guys? It is given in the beginning itself, if you can see, 25%, and that has to give us what? That has to give us the interest payments after tax. How much is it? So from T1, it's going to be, I can take the calculation, it's going to be $6 into 0.75, if I'm not wrong, 4.5, right? So what is the cash flows that I can expect to have, guys? From T0, T1, and then T2, T3, sorry, and it is redeemable after 5 years. Yeah, T5. Now comes what? Now comes, there is a conversion option which is coming up here. Now, would you redeem it? Would you convert it? Guys, understand T0, T1, T2, T3, T4, T5. So from first year onwards, I will go ahead and make this payment. I'm not saying no to that. But the last year, you have to see whether will I have any kind of, let me make it. So at the last, I have to find out what is my conversion option. So if you guys see, I have issued 20 million loan notes of book value, where it has an option to convert into 20 ordinary shares for every $100 of bond, but the current share price is expected to grow by 4% per year for the next 5 years. First, what should I know? I should find out the share price in 5 years' time. For that, I should know X dividend share price. What is my X dividend share price? My X dividend share price is equals to my cum dividend share price. That is nothing but $5.25. In this, I minus the dividend that is about to be paid, which is 0.5. I'll get the X dividend share price. What is the X dividend share price, guys? It shall be somewhere around 5.25 minus 0.5. That is 4.75. Fair enough? Yeah. This is expected to grow. Understand? Grow at 4%. So hence go ahead and compound and find out what? Compound and find the 5th year share price. How do you do? Compound it. So you take 4.75% into 1 plus 4% raised to the power 5. This is my share price after how many years? After 5 years. So now use this and convert into, so each loan note can be converted into 20 shares multiplied with each share having a value of 5.78, guys. So that means the conversion option should give us this multiplied with 20, 115.58. Looks like redemption is lesser, because redemption is how much, guys? Redemption is, you can redeem at $105, lesser than conversion. So hence the loan note holder will choose conversion. So that means my T5, it is not only the 4.5 plus this amount. Overall, I'll have a cash flow of so much. But right now, what is the shares are getting traded at? It is getting traded at, the bonds are, oh sorry, it is $100. Yeah. So right now the shares are getting traded at what? Traded at 105. So what you guys have to do now, don't waste your time in anything else. What you have to do to calculate the cost of debt, you will not sit and do interpolation method. All you have to do is IRR, open the bracket, select all the cash flows, guess a percentage, you should get IRR. So if you convert into percentage, your IRR is 6.07%, or you can go ahead and consider 6% shall be your cost of redeemable convertible loan notes. We know the cost of equity is 7.1, cost of 10.7, cost of preference shares is 7.1, and cost of debt is 6%. Now using this, what should you do? You should go ahead and calculate the market values of each of them. Yeah. So once you calculate the market value of each of them, what you can do, you can go ahead and calculate the weighted average cost of capital 2, guys. So how do we do weighted average cost of capital? For that, we need to calculate the market values. So how do you calculate market values? So first I will start with what? I will start with equity. Because equity is very simple. I have 10 million shares multiplied with X dividend price. How much is the X dividend prices? Which we have calculated 4.75. Don't take 5.78. Right now it is 4.75. The market value of equity is 10 million. 10 million multiplied with what? Multiplied with 4.75. You can calculate in thousands, guys. It's okay. Do the calculations in thousands. Preference shares. Preference shares. How many shares do we have? We have 2 million preference shares multiplied with, it is trading right now at $1.12. So that is X dividend directly. 2 million multiplied with 1.12, it is 2240. Yeah. Then for loan notes, what is the market value? So I have 20 million loan notes, right? The nominal value is $100, but it is trading at $105. The market value has to be how much? 20 million multiplied with 105 upon 100. So that becomes my market values. So what is the total capital in the business, guys? Total capital in the business will be the sum of all of this. And take the respected cost of capitals too. So now what you have to do, you should write the cost of capitals, all of them. What is the cost of capital of your equity? The cost of capital of your equity is 10.7 percentage, and cost of preference shares are 7.1 percentage, and cost of loan notes are how much? 6 percentage approximately. So convert all of this into percentage. Right? This is my cost of capital. Now you can use the weights to calculate what? To calculate the weighted average cost of capital, everyone. So 47,500 out of 7740 is bearing a cost of 10.7 percentage. 2240 out of 7740 is bearing a cost of 7.14 percentage. And 21 million out of 7740 is bearing a cost of bearing a cost of 6.07 percentage. So what is the overall cost that we can expect to have? It is nothing but the sum of all of this should give me the weighted average cost of capital. Convert that into percentage. Your weighted average cost of capital has to be, WACC has to be 9.2 percentage. That should be the answer for this one. And you do this, you'll get what? You'll get a good 12 marks, guys. I hope we are clear on this. 9.21 percentage. So this is how the whole question is considered. Okay. Now comes the last question, guys. What is this last question? See, the last, that's all. So you should be getting 12 marks for this. Now the last question is, they're asking you to discuss what? They're asking you to discuss. Very simple. Discuss the reasons why the cost of capital for Roper company might change if the company raises significant new finance through a larger issue of debt. That is what you have to go ahead and write. Because I'll give you an idea how to write an answer, of course. Like, see, maybe I go for a debt more. The Roper company will change the capital structure. I mean, their gearing will change. So, which is likely to cause the WACC to also change. Isn't it? Right? Firstly, debt is cheaper than what? Debt is cheaper than the equity, everyone. The debt is cheaper than what? Cheaper than the equity part. So if you go ahead and issue debt more, because of this, what happens? You can expect to have the WACC is already going. Will it go up or down? They have asked only to theoretically explain. Correct. So you can only expect to have some theoretical answer, everyone. Okay, so there are two concepts, which is one is forcing the debt, another one is the Modigliani and Miller's theory here. So what I want you guys to do is, it is an 8 marks answer. I want everybody to try and write the answer, and you guys can actually post your drive link in the comment section. I will go and I will evaluate our answer, and I will be giving the feedback personally if you guys can do it. Right, that is the homework for you for attending the whole pre-mock session. But however, yes, you guys can go ahead and complete this. See, once you complete this, the question number 35 is for you guys. Yeah. So once you complete this, you can go ahead and end the exam here. Maybe if you want to review anything, you can go ahead and review. You have an option to review here. Review what is incomplete, review flagged, or review all. Correct. From the beginning, you can go for a review and you can go ahead and end the exam. So once you end the examination, guys, so it will tell you to close back, and you guys can go back here, and it will tell you can go ahead and mark the exam. So what is marking the exam? You can always see your answer. Right? You can always see your answer. So if you see the 60 section A, B, we got 60 out of 100 because section C is something that is not evaluated. So section A, if you guys can see, we got how much? We got the entire 60 of 100. If you can see the roll up score, that means the entire section A and B is absolutely right. Right. And you can also go to the section C answers. Like for example, if you go to here 31, you shall be able to see the section C answer and you can do the self marking. See, this is our answer, what we have done. Correct. So you can go for a sample answer here. This is the sample answer, which you guys can actually go ahead and find out whether my answer is right or wrong. Right. Yeah. So but theoretical answers, of course, it is very difficult for us to understand and analyze sometimes, but it is totally fine, guys. I shall be able to evaluate and give it to you guys, provided if you upload your answers in a drive and take the drive link and send it on a comment section, or else you can always send your answer to me to my mail ID, which is mentioned in the channel's description. Right. So this is your entire financial management pre-June 2026 mock exam, which we have completely unveiled it. Apart from that, for financial management, I know writing a theoretical answer is very, very difficult. Guys, when you message me, when you send a mail to me, I would be sharing you guys a link where I have prepared separately, a notes where I have prepared separately a set of theoretical questions which is very important for the exam, which might come in the exam. So a set of theoretical questions from investment appraisal, from working capital management, and also from the risk, and also from the cost of capital or the sources of capitals. So I have prepared a material where you guys can message me or you can send a mail. You shall be able to get that notes to you. Right. Thank you so much. I know it is a quality 2.5 hours of time that you guys have spent on your mock, and wish you all the best for all of you guys who are writing this June examination, irrespective of whichever this exam is. Please don't get I would say don't get nervous for the examination. It's all in there. Don't sit and read new topics right now. I would suggest you to go master the existing topics, whatever you know already, instead of trying to know something new which might not be your cup of coffee. I would suggest you guys to please go ahead and revise and repeat the topics which you already know. Master it first before you go ahead and move for the different one. Right? Yeah. Thank you so much for staying so long, guys. I hope all of you guys will pass and message me. All of you take care.